Welcome, everybody. Thank you for attending the Multifamily Credit Fund update. My name is Michael Episcope. I'm the co-CEO of Origin Investments, and I'm here today with Tom Briney, Managing Director and Head of Credit. And I'm personally excited to be here as this is my very first Multifamily Credit Fund webinar, and it's great to be collaborating with Tom on this as well. So welcome, Tom.
Thanks, Michael. It's been a while since we've been on a webinar together. I'm pumped to do it again.
Awesome. Great. Tom was recently promoted to head of credit, and you're going to see why as he presents here today. Tom thinks like an owner. As an investor, he's a wealth of knowledge, understands real estate fundamentals, and is incredibly detail-oriented. And most importantly, a great person and somebody who I consider a friend. And I've had the pleasure of seeing Tom develop over the last 12 years in both his professional and personal life. When Tom came to Origin, he was single and now has a beautiful family who I've also gotten the pleasure to know over the years. And I already see you smiling, Tom. And if you ever want to see Tom smile, you just ask him about his kids. So Tom, if you want to give a shout out, right, what's better than your kids seeing dad like on what they view as TV? So feel free to right now.
Thanks, Michael. I love Layla and Bowden and my whole family. They're awesome.
Awesome. Good. And hi to Layla, Bowden, the whole family. So today we have both existing and prospective investors on this webinar. And as a reminder, this is a fund update. We're not going to be going over the basics of K-Series or the fund itself. We assume you are coming to this webinar with that knowledge. If you're new and want that information, please either reach out to someone in our investor relations department. You can email them, investorrelations@origininvestments.com, or you can go to our website and download the deck directly from the website. And I will give you one piece of basic information to save some of you a lot of time. This fund is for qualified purchasers only. A qualified purchaser is someone with 5 million or more of investable assets. K-Series are considered bonds and securities by SEC rules. So we unfortunately can't allow anyone into the fund who isn't a qualified purchaser. What we are going to be going over on the webinar today is the fund performance, and we'll give you some insight as to what's happening in the market, how the fund is doing, et cetera. And we certainly appreciate your questions in advance. They help us shape the discussion, which will last right about an hour. Tom and I are going to spend around 35 minutes on the presentation portion and then open it up for Q&A. And if you have questions along the way, just enter them into the Q&A box, not the chat box, the Q&A box. And we're going to get to them as soon as it's over. So we always have just an open forum, a dialogue with investors, answering your questions live. Today we'll do the same. So let's jump into the presentation. Slide 1 here. And most of you are familiar with Origin and our track record. And I said I wasn't going to go over the basics, so I'm not going to read anything from this screen. But I think there are some things that really matter, especially as it comes to this investment. Our motto is to protect and grow capital, and protect comes first because that's the basis of risk management. And K-Series bonds, they offer some of the highest yields with the lowest risk of any investment I've seen in my career. I'm sure some of you have heard the history of how Tom brought this to us, but it really is an incredible opportunity for investing in this particular market. It's our experience, though, on the common equity side, owning assets and being in the first loss position that perfectly positions us to be able to evaluate risk, price bonds, and ultimately generate high risk-adjusted returns to you and us. And we've been on the equity side for more than 15 years, and that is the first loss position. And that's the lens in which we view the world. In the case of K-Series bonds, the underlying assets, they start with an equity cushion of around 35%. The bonds are collateralized by loans issued by Freddie Mac, and Freddie generally loans around 65% to value on high quality institutional properties to borrowers like us. We actually are Freddie borrowers. And the equity has to be completely wiped out before $1 of capital is at risk. Well, we've never lost money on the equity side of the equation in multifamily. So starting with a 35% cushion gives us a huge advantage when it comes to investing in K-Series bonds. And I always tell people it's much easier to go from the equity side of the equation into credit, then from credit into the equity side. And that's exactly what we're doing here. And that's why we're set up to succeed. In the event something unlikely does happen, some of the bonds become impaired, we have the expertise and the infrastructure to acquire the properties directly from the loan pool, build additional value for the fund. An impaired loan, it can actually become a great opportunity for this fund. Now, I don't think we're going to see many distressed opportunities, really for three reasons. And I'll get more into the fundamentals, but the first is the fundamentals of real estate are strong. The second is our strategy. We're staying away from the riskier vintages. We're evaluating the bonds. Tom's going to go into a lot of depth into this. And then it's the collateral of these bonds. It's extremely high. And given where we are in the market cycle and what's going on in the world today, I can't think of a better place to invest than credit, because there are a lot of precarious things are happening in the world right now, especially the geopolitical scene, but specifically in credit, in K-series bonds as well. And this is where the dislocation is happening and where some of the best risk-adjusted returns can be found in the market today. Let me jump into the next slide, which is state of the market. And as they say, a picture tells 1,000 words. So what I have in front of you here is our two charts. On the left is an interest rate chart, and on the right is for sale housing affordability. And the reason why I'm showing these together on this slide is that a bond is a derivative of its underlying collateral. We aren't buying real estate in this fund. We are buying bonds. The health of those bonds, though, is directly correlated to the health of the underlying collateral, like any bond you buy out there, which in this case happens to be real estate debt. But in order to truly understand the opportunity, you have to look through to the fundamentals of the collateral to see how strong those are, and also the structure of the bond. Now, as we know, everyone's familiar with the chart on the left. Interest rates have spiked from 1.5% around 12 months ago. It's kind of crazy to think that we were below 2%. Last week, they hopefully peaked at around 4.3%. Today, they're hovering around 4%. And one of the areas that has been impacted the most as a result of the rise in interest rates is potential homeowner. Home ownership, that's the chart on the right, it has never been less affordable than it is today. More than 20 million people can no longer afford to buy a $400,000 home in the United States. And why this matters is because many of these would-be homeowners are renters today. And the rent-to-own index, it's dramatically shifted in favor of renting as a result of 7% mortgage rates and sky-high construction costs. And these trapped renters are creating even greater demand for multifamily apartments. On top of that, we have a hangover from 2008. We have an undersupply of housing by the tune of around 4 million housing units in this country right now. And that, by some measures, is going to take more than a decade to correct. So I know we all see cranes in the sky. We see multifamily going up. We see build for rent. We see for sale housing. That doesn't get solved overnight in this country. And it's that demand segment that drives the value for our underlying collateral in these bonds. And it's incredibly strong. And so that doesn't mean that the market can't pull back and go lower in the next year. If any of you have watched any of our other webinars about our equity funds, we actually are looking at a potential recession next year, looking at a drop in rental rates. And that absolutely could happen. But investment in this fund, it's about looking out 5 to 7 years, evaluating the collateral. And over that time period, the fundamentals are incredibly strong for this market, even on the equity side. And that's why we love this investment today. There are opportunities to generate low teen returns with far less risk than any other opportunity in the market looking to achieve the same kinds of returns. And I think that interest rates have overshot. I think the Fed is going to do their job. I think that you're going to see them squash inflation over the next kind of 6 to 12 months. We know that in November, rate increase is coming. The December rate increase is still in question, although the market is predicting that it's going to happen. But these are moment in times. And so when you think about market cycles and where the opportunities are to invest, the public markets reprice first, and then they also recover the fastest. So what I believe, and this is sort of echoed by the rest of the team, is this is a moment in time and the markets will recover. And this opportunity is going to be around for the next 3, 6, 9 months, and then reprice once capital returns. Next slide, please. So this is just the basics of the portfolio, and I'm going to end here after I'm done with this slide and then hand it over to Tom. The fund is open for investment through January 31st of this year. It is a closed-ended fund. It'll be about a total of 6 to 7 years in duration. We've raised and called around $160 million and invested that capital across 17 bonds. We do have some cash. Tom's going to talk about where we're going to deploy that when he takes over. The fund is generating around an 8% net yield today and an even higher IRR, because some of our bonds, they actually accrue interest rather than pay current. But if you come into the fund, you can expect a current pay on a monthly basis. Most of the portfolio is in floating rate bonds, and we're now evaluating several fixed rate instruments, as it's really time to sort of lock in these higher interest rates and get in front of what we're saying as a 10-year really attractive levels today. Our position, it's leveraged at 38. And when we sized up the leverage initially, it was really done through various stress tests, looking at COVID and even going back to as far as 2008. It's very conservative. And our whole goal is to make sure that no matter what happens in the market, when there's a shock, that none of our repo lines are going to get called, right? If we're about protecting capital first. If we were about just generating the highest returns, we would be leveraging at 70%, but that's not our goal. 38% is incredibly conservative and a level of leverage that can withstand whatever lies ahead. So thank you very much, Tom. I'm going to give that over to you, and Tom is going to go into more depth about the portfolio and some of the bonds, and then we'll open it up for Q&A after that. Thank you.
Thanks, Michael. Jeff, let's go to the next slide. And for those of you listening live, the Q&A box is wide open. We're starting to see a couple of questions in, but as you think of them, feel free to put them in there and we'll address them at the end of the webinar. I only have a couple of slides, so hopefully we can get through those and get to your questions. This is a summary of the current fund as it stands today. In the upper right-hand corner is where I'd like to start with the geographic diversification. What we focus on when we're buying any individual bond on the secondary market is geographic location first. You'll notice in this map, the darker the blue, the more the concentration we have in those particular states. Most of the heavy concentration of the darkest blue are in markets where we have exposure on the private real estate side, and Income Plus and Growth Fund 4, QOZ, it's Arizona, Texas, Colorado, Florida, Georgia, North Carolina, Nashville. So the intent is very specific. We want to have overlap from these bonds relative to where we're doing our private real estate investments, because we know those markets intimately well and we understand the risks of those markets. There is some exposure to the coast in these bonds. Freddie Mac does not discriminate where they originate loans and put them in the pool. So we do have coastal exposure. When we're reviewing bonds on the secondary market, we have the opportunity to invest or not invest in bonds that have over concentration or overweight in the coastal markets. And those are the bonds that we tend to avoid just because we understand that those are less likely to perform as well as our target markets, which is why we've elected them to be target markets. In the bottom left here of this slide, we talk about the kind of the security and the healthy metrics of the current portfolio. So our average underlying properties are levered at about 67%. That means there's, said differently, a 33% cushion of borrower equity or cash ahead of our first dollar of loss. As Michael mentioned at the beginning of the webinar, we're historically accustomed to being in the true first loss position and not protected by 30 or 35 or 40% cash equity ahead of our investment position. So this is extremely comfortable position for us to be 67% loan to value. But more importantly, especially when it comes to credit, is the second metric, which is the DSCR, or debt service coverage ratio. That's important because that's how much cash is available at the property level to pay the debt obligations. And the debt obligations is our current income, right? So this means that for every dollar of debt obligation or interest payment required to be paid every month, there's $2.20 worth of cash available to make those payments at the property level. So there's a lot. Not only is there a 33% cushion from a loan to value perspective, but there's more than a 50% cushion from a cash flow perspective, or what is available to pay our debt service coverage and ultimately the interest that flows through to you, the investor. There's more than 1,000 loans in this portfolio. That's good geographic diversification, as I mentioned at the beginning. What's interesting about this is there are 5 loans which are on the watch list, which is different from being delinquent. Delinquent has missed a payment or is delayed in making a payment. A watch list is a designation that is provided by the special servicers of these bonds in saying something isn't going exactly as planned. And so that can be a huge array of things. 5 of our 1,071 loans are on the watch list. And it's from a range of things as one property was hit by a tornado and had partially destroyed some of the property. And so there was an insurance claim made and the property is being rebuilt. And so a 1990s vintage property is going to be half 2024 vintage when it's complete from the reconstruction. I don't view that as a real risk. There is insurance proceeds to fix the property, but it is nonetheless on the watch list. There are another watch list asset is one which is going through a renovation. And so the occupancy has dropped below 90%. That is an automatic flag from Freddie Mac, regardless of why it's on the watch list, or regardless of why it's dropped below 90%, it ends up on the watch list. What my point in telling you all this is a very healthy portfolio, and although there are assets on the watch list, we watch them every single month as reports come in, as the payments come in from the underlying collateral. We're very, very in tune with what's going on at the property and understanding what the risks are before they become real issues, and knowing is there a true risk here? Is there anything we can do about it today? And how do we make sure that we protect that downside going forward? On the bottom right here is the portfolio construction as it stands today. This is a very specific and bespoke construction that we've been focused on really for the last 9 months. And that's resulted in about 70% of the portfolio being floating rate. And the reason that's important is the floating rate debt is hedged against inflation. So the floating rate bonds are a spread or an interest rate over SOFR. SOFR is the secured overnight financing rate that is effectively the same as the Fed funds rate. So when the Fed increases interest rates by 75 basis points, roughly SOFR goes up by 75 basis points as well. And so as the Fed inflicts pain on the economy, we are hedged against that beautifully with our floating rate portfolio. We've been building a portfolio in this manner since, call it beginning of 2022, because we saw the Fed tightening. Now, I don't think that everybody at Origin, frankly, everybody in the markets anticipated the Fed tightening quite as aggressively as they have been, but we didn't need to know that. As a floating rate bond, you can say we believe they're going to tighten, and we'll benefit from that. We'll hedge our yields against that. As Michael mentioned, this is a moment in time. The Fed tightening cycle appears to be coming near a top. I think that I'm probably a little bit more pessimistic as to how much further the tightening will go relative to some of the market participants. But regardless, we know there's likely to be another tightening next week when the Fed convenes, and probably one more at least in December. That will continue to be hedged against with our floating. Conversely, this moment in time will come to an end. The fixed rate product is starting to adjust pricing wise to these higher interest rate environments. And so there should be opportunities for us to acquire a fixed rate bond in the not too distant future to hedge against a lowering interest rate environment. And I'll talk about 2 specific, one floating rate and one fixed rate bond here in a minute. But the idea is this is a bespoke portfolio created to react or be in advance of future market expectations, to provide floating rate hedge before the interest rates go up, and to lock in fixed rate total returns prior to interest rates going back down. The current cash position as of 9/30 is 9%. That will go up in a pretty meaningful way as we just completed a capital call, and the capital is rolling in this week. And so I would expect to see that cash position to increase to about 18 or 19%. That will be used to acquire more bonds. Again, it could be fixed, it could be floating, it could be a combination of both. We're evaluating all of the market at all times to find the best risk-adjusted return that are out there today. Jeff, let's jump into strategy a little bit further. So vintage matters. And we're very concerned about or focused on the vintage of the bonds that we're acquiring. And the reason is we can look at specifically 2006 vintage bonds. If you've been on these webinars before, or if you've studied our multifamily credit fund deck, you know the 2006 vintage bond pool is the worst performing bond pool that Freddie Mac has originated since its beginning in 1994. 2006 was the year it was originated, not necessarily the year that the losses were incurred. Most of the losses were incurred during the GFC in 2008, 9, and 10. But it was the 2006 vintage pools that were hit the hardest at a 0.42% credit loss. Now that's still exceptionally low, but the point being that vintage matters. That's the worst loss you would have incurred if you were investing in vintages. Why is that relevant? Well, 2006 was the highest valuation vintage, generally speaking, of the underlying collateral. So when values started to decline in 2007, 8, and 9, the 2006, the highest valued underlying collateral pool, were hit the hardest. And that translates into today. We saw on the private side of our real estate, and certainly in the credit markets as well, the value of the underlying collateral become inflated from a valuation perspective at the end of 2021 and into 2022. As such, we are focused going forward on avoiding those vintages. We are focused on vintages which are 2018 through 2021, the first half of 21, because those were still fairly valued. Now, certainly at the time, at the end of 2021, you could have sold a 2018 vintage asset at an inflated price, but the point is they are protected by more equity because they've been accreting value since 2018, and they're less susceptible to the valuation swing that we saw at the end of 21 and going into 22. Our portfolio, because it is centric to early 21 all the way down to 2018 vintages, has that 33% cushion that I mentioned before. If you look on the right side of this chart, you'll see cushions that have deteriorated down to 25 or 24% in some cases. And that's fine. You still have a reasonable cushion, but it's not quite as comfortable as if you're in the 2018 to 2021 position. Again, this is back to protecting our losses and making sure that we are protecting our investment, making sure we have really mitigated our potential for loss. The piece in this bar that is relevant is that light blue, origin blue B piece. That is our protection. The purplish color at the bottom is a senior loan, and the piece above that is cash equity or accreted value to the underlying collateral. So again, the 2018 to early 21 vintage has a huge amount of protection, and hopefully our credit loss for our fund is zero. Not 0.42%. Now we always underwrite an actual loss at the beginning when we evaluate these bonds, but the expectation is that we don't incur any. Jeff, let's move to the next one. This is a floating rate bond example that is actually part of the fund today. This is a bond that we bought in early 2022, but it was originated in 2018. So it has all of that cushion that was shown on the prior slide. At origination, this had a loan count of 42 loans. By the time we acquired it, it had 10 loans. We bought this from a truly, truly institutional buyer. They're one of the largest, if not the largest buyers of Freddie Mac B pieces out there. So the question is, why are they selling? Well, they own so much product that they don't necessarily understand the underlying collateral and the nuance of the underlying collateral for each particular loan and each particular bond in their portfolio. So when we were looking at this bond, again, there were 10 loans in that portfolio at the time. We knew or know the borrowers of 6 of those 10 loans personally. We have relationships with them at a personal level. We've actually invested with some of them in joint ventures. So we have this intimate knowledge of the underlying collateral that this seller didn't have. And so we were able to buy this bond at an extraordinarily attractive rate of 680 basis points over SOFR. At the time, SOFR was about 1.5 or 2%. So we felt really, really good about the returns at the time, and they've certainly only gotten better. The loan count today is 8 rather than 10. That means 2 of the loans have paid off. And the basis has improved as well. And this is, that cushion that I mentioned to you earlier is shown in this loan to value, the 49.4 versus the 70 at origination. That's a function of accreting value as well as some of the higher loan to value loans in the underlying pool getting paid off. And again, back to the most important piece of any credit is how much cash is available to pay down the interest expense and the principal payments that are required. In this case, the DSCR, again, the debt service coverage ratio is 3.43. That means for every dollar of loan obligation, there's more than $3.40 available to make those payments. I feel very, very confident in the ability for the underlying borrowers to pay our interest expense going forward, not just because we know them well, but also because there is a huge amount of cash cushion and loan to value cushion on this bond. Now, the question is, okay, so why don't you buy a bunch of floating rate bonds that look just like this? A, there's not a lot of them, and B, there's upside and downside to floating rate bonds. And this is why we haven't gone 100% into floating rate in the fund. The upsides are there's an inflation hedge, right? As we talked about in the prior screen, and you get current payment. Our fund currently pays on a monthly basis. Again, about 8% is the current yield that we're generating right now, and that'll fluctuate up and down as SOFR changes, as loans prepay, and as we have higher cash balances or lower cash balances. So roughly 8% today. It'll continue to fluctuate. I would expect it as SOFR goes up, we should be able to increase that a little bit. And as SOFR goes down, that yield will go down a little bit. The downside to floating rate bonds is that you have an uncertain duration. This bond was a 10-year bond at origination. So in 2018, it should expire, or all the loans should be paid off by 2028. But it's only 2022 right now, and there's only 8 bonds remaining. That's a function of the underlying collateral having a very easy prepayment, meaning that the borrowers can prepay at any point in time. And that's a challenge for the bond ownership because we're not certain, we can't control the duration of this bond. And so although it's very attractive today, it may not be around in 2028. It could be fully paid off by the end of this year. We just don't know. And so there's a lot of uncertainty around that. And we believe we need to get paid for that risk of duration. The other risk to the floating rate bonds is falling interest rates. As I mentioned before, and as Michael mentioned, I think this is a point in time where SOFR is at 3.6% and climbed to maybe 4.5, 4.8, maybe 5%. This is a point in time. And if SOFR gets to 5%, almost certainly we'll be in a jobs recession, in a challenging economic environment, and the Fed will be forced to lower interest rates again. That would be bad for the floating rate bonds because, again, they're based on SOFR, and as SOFR declines, so too do our interest payments that we make to our investors. So pluses and minuses to both to the floating rate bond. That's the same with the fixed rate bond. Let's, Jeff, flip to the fixed rate. This is a bond that we're evaluating currently. Again, it's 2022, but this bond was originated in 2018. This is a fixed rate bond, meaning all of the underlying collateral in this bond has a rate which is fixed, like most people's mortgages, where you say, okay, I'm going to take out a 10-year loan. It's going to be fixed at 4.5 or 5%, and it'll stay at that rate until the loan becomes due. The nuance of this bond is our payment is also fixed. So it actually accrues to us. So there is no yield in a fixed rate bond. We buy it at a discount to par. So if it's worth $100 in 2028, we would buy it today at a discount to that $100, call it $45 or whatever that price might be. So this loan at origination had this pool had 48 loans at origination. Today, there are 35 loans in it. So certainly a much lower level of prepayment than in the floating rate. Again, it's more challenging to get out of these loans as a borrower. That's the risk and return that they take as a borrower is they lock in a really attractive fixed rate cost to their debt, but it's more challenging to get out. Our basis in this has not changed from $138,000 a door, but our loan to value has. Again, this is the accretion based on the underlying collateral increasing in value over time, plus some principal pay down through amortization of the underlying loans. So this went from a 69% loan to value at origination to 56 today. And similarly, the debt service coverage ratio is still very healthy at $1.50 for every dollar of loan obligation. So certainly a very, very attractive bond as well. The pluses and minuses, I mentioned a little bit of the nuance to not generating any yield. That's a downside. So we buy this as effectively a zero coupon bond. We buy it at a discount to fair market value. and we generate the return that we acquired at. So if we buy it at a 10% yield, a 10% total return, we will generate a 10% return. That's it, assuming no losses or losses in line with what we're underwritten. The downside to that is there's no hedge against future interest rate increases. So that's why we haven't been buying these bonds as interest rates have been increasing, is because we understood that interest rates were going to go up, and we want to make sure that we were capturing that interest rate increase. As we believe we're getting near the top, we'll lock in that 10% or 11% or whatever that return might be, whatever we can achieve, and we'll lock it in for the next several years as interest rates go back down. So as interest rates go back down, it doesn't go from 10 to 9 to 8, it stays at 10. That's the upside of this. The other upside is the duration. As I mentioned, the challenge with the floating rate bond is the duration is a little bit unpredictable. We have 100% certainty, or I should say nothing's 100% certain. We have 98% certainty that these bonds are likely to run through their duration. So this particular bond I said was 10 years. It's actually a 7-year bond. So it would run through 2025. We have a 98% certainty that this bond would run through 2025. And we would be able to generate not just the total return, but the multiple on invested capital as well, which would be, which is really ultimately accretes to total return at the fund level. So all of this to say is we're evaluating both fixed and floating rate bonds. We have overweighted to the floating rate to hedge against inflation, and which you saw a couple slides prior. And we're moving that towards the fixed rate evaluation, at least in the near term, to see if it makes sense to start acquiring these fixed rate bonds to hedge against that, what we expect to be a reduction in interest rates over the next 18 to 24 months. With that, Michael, I believe that's the last of my slides, and we're going to move to Q&A.
Great. Thank you, Tom. I will take the first question. What types of distress, if any, do you see coming in the multifamily market, given the quick up move in interest rates? I covered this on the macro update and the outlook for multifamily. I spent some time on that, talking about the underlying collateral. We don't see a tremendous amount of distress. Certainly there will be problem assets, but if you think about the collateral within the pool of K-series loans, these are borrowers who are institutional in nature. And if they want to continue to borrow from Freddie Mac going forward, they can't have a default and a loss. And so it's the Origins of the world. It's the sponsors who we work with. It's the Blackstones of the world who are in these pools with us. Now, that's not to say there won't be pain from the investor side, because I will tell you that those who bought value add and core plus assets at the end of 21, the beginning of 22, even the first half of 21 are going to see some pain. We saw cap rates trading at 3.5%, and now we have borrowing costs that are 5.5% today. But when it comes to, even if we go back to 2008, the high quality assets, they didn't fall off the Apple truck. You still had a kind of an orderly liquidation of high quality assets. They all came down in price together, but the stuff that was truly distressed were the projects that were ill-conceived, they were undercapitalized, inexperienced sponsors, and that's not the collateral within this loan pool. And that's really important to understand. We talk about the fundamentals of real estate being strong. I already went over those. You have a housing shortage in this country. You have migration patterns that are happening from the north to the south. And you have a lot of great things setting up for multifamily. So there will be some pain from the investor side, and certainly in some of these funds that have bought properties, but it won't be this massive distress that some people are talking about out there today.
So there are 2 questions from Kirk. Thank you for sending them in, Kirk, that address or ask about loan to value and DSCR. And there's a couple of loan to value questions as well. The question is loan to value updated and is DSCR updated periodically, or is it only at the origination of the loan? Freddie Mac, when they originate the loan, they provide a loan to value at that time via an appraisal, which is something that as the buyer of the B piece, we have the opportunity to look at and to understand and dig into. The loan to values that are reflected in the presentation today and that we understand are based on our valuations of the underlying collateral. So when we dig into the portfolios, we say, here's what's happened to NOI, here's what's happened to cap rates, and we dig into each property of the underlying. So we've looked at all 1,071 assets which we own in our bond pools, and we assign a loan to value to those assets. So although Freddie Mac does not adjust the loan to value, Origin does. And the question around debt service coverage, is that updated? So a little bit. It's different between the fixed and the floating. On the fixed rate side, we'll start there. It is updated by Freddie Mac on a monthly basis based on updated property level cash flows. So as NOI comes in on a quarterly or sometimes an annual basis, the underlying collateral sends in, the borrowers from the underlying collateral send in their new calculations for NOI, property operations, that sort of thing. That is automatically updated based on the fixed interest rate that is occurring in those fixed rate bonds. The floating rate bonds are also, that's happening, but it's a little bit more nuanced in that the floating rate, the underlying collateral is also floating, meaning that as SOFR goes up, that borrower's payment also goes up. And that is updated by Freddie Mac. The nuance to that is every borrower for every Freddie Mac loan that's originated is required to have a cap. They're required at origination to pay for a cap on SOFR or LIBOR, depending when the loan was originated. And so if you originate a loan, and Origin has originated loans, when SOFR was at zero or pretty close to zero, Freddie Mac says, that's great. I understand that SOFR is at zero today, Origin, but you need to buy a cap so that if SOFR goes above 2%, the max exposure you have as a borrower is SOFR at 2%. And when Freddie Mac originates the loan, they underwrite to a debt service coverage of 1.0 at that cap. If nothing else changes, the debt service coverage will still be in place at least 1.0 at the capped interest rate. So what happens, and this is getting a little bit technical, but I'll go down the rabbit hole anyway. What happens if SOFR goes to 3.5 or 3.6 like it is today, but your cap is at 2%? The way it works is I, as the borrower, have paid, if I am the borrower, have paid for a cap at 2%, and I have paid that money to a counterparty, a JP Morgan, a Bank of America, one of those groups. And in exchange, they say, if SOFR goes above 2%, I will pay the difference between 2% and what SOFR is. So if SOFR goes to 3.5, it's 3.5 minus 2. That 1.5% is what the counterparty, JP Morgan, Bank of America, et cetera, is required to pay. So as a B-piece buyer, Origin gets the benefit of that SOFR at the fully exposed 3.5 or 4%, but the borrower, the underlying collateral that was underwritten to a 1.0 debt service coverage ratio, is only limited to that 2% SOFR rate. So the true counterparty risk in the floating rate bonds are these huge national and international banks that have outstanding balance sheets. So that gives us additional comfort, not just in the credit of the underlying collateral and underlying borrower, but really that part of our interest payment is coming from a true institutional bank. I think that's reasonable.
Great. Thanks, Tom. We had a couple questions. One person asked about vintage, what it is. Vintage is very simple. We look back at when Freddie is originating mortgages, they originate them at a moment in time, and then they package those all up together. So when Tom was talking about the Q1 2018 vintage, the Q2 2018 vintage, and going through time there, what that is those are moments in time of properties that were packaged together. And the reason why that's important is because if Freddie loans to a value at that point of 65 to 70% on that loan, and that was 3 or 4 years ago, but then the market has appreciated on average of 40%, that becomes your cushion. And that's what Tom was pointing out in that slide about why vintage matters. So they're bundling up from a certain time period. And those are the loans that we're going after. And somebody had emailed this in and said, I have serious concerns about floating rate mortgages originated in 2021 and the first half of 2022. Does the fund own any? The answer is, so are we. We're very concerned about those vintages as well. This is why Tom went over and sort of talked about the vintages that we're targeting. The answer to does the fund own any? The answer is yes. We actually, 8% of the fund is exposed to this. This was a direct participation with Freddie Mac. But going forward, the fund will not participate in anything of those vintages. And it's not even the beginning of 2021. It's really the second half of 2021 and certainly 2022 going in there. And we want to target those loans with a higher cushion against loss and more appreciation that's occurred. And Tom, feel free to add to that.
Yeah, part of the Freddie Mac portfolio requirements is that you sometimes take the good with the bad, and you have to mitigate that with your loan loss reserves, which all of our underwriting accounts for some loss. Even though the vast majority of the pool is, again, referring to that historical loss ratio sheet that we've shown from Freddie Mac, most vintages show no losses, and those which do show losses are pretty limited. But all of our bonds, regardless of vintage, are underwritten assuming some loss occurs, and which actually translates into this question from John, which says the loan interest rate charged borrowers will be dramatically higher than those which were underwritten, which we talked about a minute ago with the caps. How do you stress test whether this will cause individual loans or defaults? And that's a great question. Again, it gets back to how we underwrite these loans. We take a very close look at the underlying collateral. And when I underwrite it and the team underwrites it, we're looking at it from an equity perspective. And what would it look like if things go sideways? How much loss is probable on each individual loan? And then we stress standard deviations around SOFR movements in those debt service coverage ratios. The nice part is, again, they're all required to have a cap. And when those caps expire, they're required to have a new cap. Freddie Mac requires them to start holding back or reserving cash from operations to purchase the new caps at the fair market value of the current caps. So there is a lot of hedge that's in place already from an interest rate payment perspective. Once an asset comes onto the watch list, and I mentioned we have 5 assets on the watch list, which we watch every single month. I dig into them, I understand what's going on. A lot of times, it's, hey, they didn't send in their report on time, and so they're on the watch list. And then you get the report and they're 99% leased, and frankly they were just too busy to send in the report, but they sent it in. It looks great. And so as these come onto the watch list, we take a deep dive. We have very good relationships with all the servicers and special servicers of these bond pools. We can get directly to the borrower and understand what's going on and update our loss reserves. So everything that we underwrite assumes every bond, we'll invest in a $30 million position that'll have a $2 to $3 million loss provision in it. And that's baked into our initial underwriting. And so that's an upside option. If we don't actually achieve any losses, that's an upside option going forward where we don't have to lose $2 million or $3 million in a bond pool. And then as we see risk assets becoming higher risk assets, we'll address those accordingly and provide updates to our investors.
There were a lot of questions around taxation that I'll address. Does this fund generate individual state tax returns? Somebody else just had a question that said taxation. And does this fund protect capital gains from the IRS? The fund generates ordinary income. So it's ideal for investors who have losses that they can carry forward, offset that ordinary income for non-taxable accounts. The fund does have a REIT blocker, which back in 2017, there were some very favorable laws that were passed where you get a 20% tax deduction. So instead of being in the top bracket of 37%, the maximum you'll pay on this fund is 29%. So it's as tax efficient as it can be, but everything is going to be coming back as ordinary dividend income. And by the way, there are no state tax returns in this fund. You'll only get one K1. We have a REIT, and then above that, we have an LLC on top of that. So the REIT acts as a blocker, but you will not get multiple state tax returns. Can you confirm that, Tom?
You can confirm that. Yeah, no, I believe, yeah, I haven't received a state tax return. That's correct.
Okay.
That would be 40 something of them because
yeah, that would be a little, right. Okay, thanks.
So Greg asked the question, do I view 2022 as the highest risk bond pool? And I'm going to answer a couple here. Yes, I do think that especially the first half of 22 is the highest risk. Again, it's still very low risk because the underwriting, let me back up a little bit and talk about Freddie Mac's underwriting acumen. They are very, very conservative, and they have a target each year of how much production they're going to do. In 2021, their target was about 70 billion. They barely hit that target. 2022, their target is 78 billion. They are not going to hit that target of production this year. Meanwhile, every other lender in the universe outside of the GSEs, Freddie, Fannie, Ginnie, and HUD, will far surpass their targets. And in fact, they did far surpass their targets by June of 2022. And the reason Freddie didn't is because all these other groups did, and they were getting extraordinarily aggressive. These are the debt funds. These are the local and regional lenders. We're extremely aggressive on their underwriting, and Freddie maintains their discipline regardless of time of the year or part of the cycle. They maintain their discipline in underwriting standards. So yes, I do view 2022, especially the early half of 2022, as the riskiest portion since the GFC, I would say since 2006. It is the riskiest portion, but it's still a very low risk proposition because Freddie Mac doesn't go to meet the market. They hold their standards in a very tight window. This is how we underwrite. It has to be defensible. It has to appraise out. And therefore, they're just not going to produce as much. They're only going to take the highest performing loans and put them in their pools. And so, yes, it is higher risk than the first half of 2021, but it's not, you will not see the loan losses in Freddie Mac originated multifamily loans that you will see across the board in other multifamily loans, whether it's CMBS or life companies or other loan originators will have higher losses than Freddie Mac. That's why we've elected to put this fund in Freddie Mac only, is because it is the safest multifamily collateral you can buy as a bond buyer universally. That was question number one. And maybe I beat the vintage horse to death, but sorry if I did. The second piece of the question is, how do we select for adverse selection, i.e. good loans paying off early and bad loans staying in the pool for longer? Again, every loan or every pool that we look at, we underwrite every single loan and we allocate losses accordingly based on that adverse selection, the good loans paying off and the poor loans staying in. And in loans where we see a high number of watch lists that are watch list loans for good reason, not just because they missed their payment or missed their reporting requirement or because they were hit by a tornado and they're being rebuilt, but because there's an actual fundamental issue at the property level, we just won't buy those bonds. We'll pass on it, or we'll pay a price that if we have a material loss in that bond, we'll still generate a really healthy return. And so all of that is accounted for at our initial underwriting.
Tom, I have a quick question to answer, and then I'm going to hand it right back to you. Somebody asked, when will the Multifamily Credit Fund 2 commence? January. Back to you.
That was quick.
Well, in all seriousness, yeah, we've already, so we can only raise money in this fund till the end of January. So we're already talking about what does Multifamily Credit Fund 2 look like, and that's kind of on the top of our list, getting together those business decisions. There's some things we're looking at. Will it be another closed-ended fund? Will it be open-ended? Those are some decisions that we're still making today, but you can expect an announcement in either December or January of that new fund.
I think the advantage of being in Fund 1 to that end is that, well, you know what you're going to get. You know what the yield is. You know what the size roughly is going to be. And as an investor, you know what you're going to get. And it's pretty baked at this point. Fund 2 will be baked as well. But this one's been underway for a year and a half, 2 years at this point. And so to have this kind of visibility in Fund 2 will take some time. So I think there's advantages to being in Fund 1, regardless of what Fund 2 looks like. Yeah. House view on interest rates, and I think this is a bigger question revolving around disciplined decision making, and so I'm going to answer it as such. The house view on interest rate is constantly evolving. I'll put it that way. We talk internally several times a week, but formally at investment committee on Tuesday mornings, and we talk about the economic cycle. We talk about deals that we see in the credit markets and the private markets. And every week, every day of every week, we're talking about where we think the world is going based on new information that we have at any point in time. Decisions are made via investment committee. So there are 5 members of investment committee, and all of them review and approve all investments, both in this credit fund as well as on our private real estate side. So it is decision made by committee. I make the recommendations of this bond or that bond and portfolio construction, but ultimately it's decision by committee, which has the ultimate say.
Yeah, we all have maybe different opinions. I'll just share with you mine and then I'll answer a question. But the Fed's going to do their job. There's a saying, don't fight the Fed. They are hell bent on squashing inflation. They're going to raise at the next meeting. They're going to maybe raise at December. They'll see. But I think being in the market and understanding and seeing this, we all know that they're doing their job. The market has come to a screeching halt in the mortgage side, the for sale side. Realtors are sitting on their hands right now. It's pencils down on the equity side in the multifamily. You finally have a balance coming back to the market, which is actually welcome from our standpoint. You had contractors and subcontractors who were naming their price, and now they're kind of worried about where is their next project coming from, because where they had 10 projects in their list, now they've got one or two. And so this is kind of part of the business cycle. The market is 4% today. Everything that we're looking at month over month, because inflation is backwards looking, suggests that inflation is ebbing. The Fed has done their job and that it's going to ease over the next kind of 3 to 6 months. And if you believe in a reversion of the mean and a recession is coming next year, then what you're really looking at is probably a decline in the 10-year of about 150 basis points from a high. And I say that because never in the history of the United States have we had a recession where the 10-year hasn't declined by at least 150 basis points. So there's a lot of stuff going on. I think we're going to be in this period of volatility and price discovery from a long time. And I mentioned earlier that some of the things that we're seeing today, the shortage of housing, is as a result of the 2008 recession 14 years ago. And this COVID roller coaster we're on, this supply chain disruption, interest rates, price discovery, and everything, we're going to be on this for a while until things, I can't tell you like 5 years, 10 years, something of that nature. But it is going to be quite a while that we're going to constantly be in more volatile times than we have been historically. There's another question here. You mentioned cap rates were at 3.5% a year ago, and borrowing costs are now 5.5%. What are the current market cap rates? I can only, so historically, like there's a cap rate to treasury spread. And historically, that spread has been about 100 to 150, 200 basis points. And that is the spread that you get paid for being in a risk asset versus a risk-free asset. So if the 10-year is at 3% and cap rates are at 4%, that is in line with historical norms. Right now, with the treasury being at 4%, you would then have to get a 5% cap rate to get paid for the risk. Well, I can tell you, nothing is transacting out there because interest rates have moved so quickly in the capital markets. Now, there's a huge bid-ask spread. We as a company are looking at cap rates starting at 4.25, even 4.5 on new deals that are being presented. And what that means is that as we drift cap rates, we're exiting at a 4.75 around that area. And deals, especially in development, they're only penciling out if we get to about a 6% return on cost. So 6% cap rate in the future after building. So this is sort of a period where most groups that you're talking to out there, including us, are pencils down. Let's wait and see. Let's see if the Fed does their job and interest rates come back down to 3.5%, then new deals will make sense. But sitting here, if the 10-year stays at 4.3, you're going to see, just the market sort of languish for a while. And the borrowers who bought 3.5 cap rates expecting more appreciation, those are the ones who are going to feel the most pain, because in real estate, you don't buy a cash flowing asset to write the bank a check every month. And that's kind of what's happened, and to the point of that later half 2021 and then 2022. So those particular properties, by our estimates, are probably on a gross level down about 10 to 15%. So if you're leveraged at 65%, your equity is probably down 30 to 40% in those particular deals. There just hasn't been a mark to market or any transactions to corroborate that. That will happen once the banks step in and force people to sell.
And that might happen. I'm going to address 3 questions in a row because they're all pretty short. Any of the properties affected by Hurricane Ian? Amazingly, it doesn't appear so at this point. Certainly, we have assets in the underlying collateral, which got a lot of rain and wind, but it doesn't appear to have any damage. Most of the collateral that we have in Florida at this point is either just outside of Miami or just outside of Orlando. And luckily, those cities, generally speaking, were spared. The second question is the duration of the fund. The final close for capital raising is January 31st of next year. There is a 2-year deployment and a 5-year hold period thereafter. So let's call it 7 years from January 31st. There is a 1-year extension option. So if we extended everything, it would be 8 years from January of 2023. So, and then finally, is future foreclosure being underwritten? The report recently shows increased foreclosure nationally. Michael just touched on this a little bit. I think the important piece about this question is there is a huge spread between the credit quality of an individual homeowner and the credit quality of the buyer and borrower of these cash flowing assets that Freddie Mac approves. Generally speaking, there is not an increase in foreclosure yet, and that's a function of the credit quality of the multifamily borrower. Most of the borrowers have a net worth of at least the value of the loan. So if you have a $50 million loan, you have a $50 million net worth and a liquidity of at least 10% of the loan. So if you have a $50 million loan, you have at least 5 million liquid. In many cases, and that's the low end of the bar. In many cases, these institutions that are buying and borrowing via Freddie Mac have multiples on the minimums required. So net worths of 200 million, 500 million, $1 billion, and liquidity that are multiples in excess of what the required amounts are. So foreclosure at the residential level is not surprising, as we talked about. And I'm based here in Denver. We saw the run up in housing market go, call it 25 to 30% in the last 18 to 24 months, and it's down 10% already. And so if you bought with a 90% loan on a floating rate loan 6 months ago, you're already in trouble. And so it's not surprising to see. I would expect loan losses and defaults to go up on the residential side, but it should be very, very muted on the Freddie Mac side.
Wow. Greg asked this question, if rates stay higher for longer, they don't fall by 150 basis points, do you think market just remains stagnant until rates go down? Greg, I think that the market will reprice. The longer we stay at this higher interest rate, it's just that in the private market, price discovery takes far longer because people don't have to sell until they're forced to sell. It doesn't mean that the market isn't lower today. It just means that there's this huge bid ask, and private owners who have long-term fixed rate debt of 5 years, 10 years, they're not forced to sell in today's market. But the longer they stay up here, the more we will see a deterioration of the underlying asset itself, under basically property values going lower, because that will just take time as people unwind, as banks force people to sell, and the market fundamentals have to come back in line. So it could happen that we don't go 150 basis points lower. It might be the 10-year goes up to 5%, and we'll just sit here, and you will see prices come back into line until the buyers feel as if they're getting paid for risk. That's kind of, that's sort of a crystal ball question. The market can go in a lot of different directions. I still stand by the fundamentals are strong in this market. This is not a real estate-led recession like it was in 2006, 2008. Lenders have been behaving responsibly for the last 10 years. The CLO market, it was just filled with junk when you go back to 05, 6, 7. And so there's always risk in this market, but we also have to look at it and use some historical context to say what could happen, what's likely to happen, but then manage risk around the extremes as well. So, we're not going to go into what we do on the equity side, but when we're looking at this, one of the things we like about case series is the protection that we have. And if you go back to 06, which is, largely, we all, most of us were around in 06 to understand what was happening back then, and the garbage and the overpricing that was happening back then. Even like we're concerned about the 2022 vintages, but if I put those up against 06, they would look incredible from a fundamental and evaluation perspective compared to what we saw in 06.
We're just about out of time, but I'll answer a quick question from Jay as it relates to distributions. If you're part of the capital call in October, November will be, you should receive your distribution at the end of November. So it's that will happen.
Great. We're done, Tom? 11 o'clock, 1 hour. So we'll sign off. Tom, always great to be with you. Thank you. I actually do learn a lot listening to you. And I think it's honestly a pleasure having you leading the credit division, the debt division, this fund, et cetera. And to everybody out there, if you're interested in investing in this fund, increasing your investment, there's still time until January. Please reach out to us. Investor relations at origininvestments.com. You can reach out to me, Michael, at origininvestments.com as well. I'll either answer your question or send you to the right place. We thank you for your time and partnering with us and your interest in Origin. Thank you.